Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World. Today being Friday, we have another fresh webinar for our audience. We have been hearing a lot about covered call strategy, from some of our successful investor clients. I have around 2 decades of experience in this industry, and I have seen few such clients who have followed covered call strategy, and when they learn and they master covered call strategy, they actually become so confident that they kind of shun all PMSs and AIF products and actually talk about their own covered call strategy. One such investor client is Mr. Vineet Jain, who is amongst us today and who has been investor himself for his family, has been doing business for 20 years of auto components and parallelly learning the art of managing portfolio through derivatives and steering the covered call oriented strategy to have a portfolio which has a lower risk and still generates higher returns. I'll repeat, a portfolio with lower risk and still generates higher returns. And because he was very successful in doing for himself, for his family, for his friends, he then realized and thought that he should actually take up the difficult role of becoming a fund manager. And hence, he, out of his passion, launched this fund, which he has very rightly named as Volvin Limited. The company's name is Volvin Limited, which is, basically trying to convey winning through volatility. So he's actually mastered the art of kind of, making volatility as his friend. Mr. Vineet Jain, in total brings with him 3 decades of experience. He has been investing in stock market, I would say for last more than 2.5 decades, because he has seen all kinds of difficult as well as good phases, be it dot-com burst, be it COVID crisis, or be it even Harshal Mehta crisis. So he brings with him a lot of experience, has seen all types of stock markets, and has kind of mastered that art. And today we want to learn from him that how actually one can generate high returns. I would not kind of give any number to this high returns as a subjective aspect, but obviously with lower risk. And today we are doing this webinar with him because we wanted to actually see the performance of the fund, and fund has completed 1 year. Over 1 year, fund has actually grown by more than 25%, despite kind of maintaining very low risk, which is obviously demonstrated by low beta statistically. We'll cover more on this and try to understand very, I would say, in an educative manner, that what is this covered call strategy all about, how is this done, and how one can actually make volatility as one's friend. Because in Indian context, there are many HNI investors who actually have a lot of money which is parked into debt funds, which is parked into arbitrage funds, which is like parked into undecisive products. The money, they are always kind of wanting to put this money to equity to make high returns. But obviously, at times market goes through sentiments and one misses the same, and hence money remains parked into some of those arbitrage funds and debt funds. But Mr. Vineet Jain has devised a strategy where that money can be easily absorbed. I do not want to just believe in his claims, though I have personally seen the returns, but I want him to demonstrate the same today in this webinar. So with you, I will also be equally keen and curious to understand and kind of get convinced about whatever he has to say. Welcome, Mr. Jain, today to this webinar. We at this platform, PMS AIF World, have been doing these webinars every Friday with all, I would say, top-notch fund managers, new fund managers, emerging fund managers, to learn with open mind. Whatever is good and interesting for our clients, we definitely offer it to our clients ourselves. And I myself want to kind of get convinced today with a very open mind. So once again, very warm welcome to you, and over to you for the first half of this presentation, where you can kind of discuss everything that I have kind of talked about, and then in the second half, maybe in last 20 minutes, we'll take Q&As.
Thank you, Kamal, for the very detailed introduction, and you have been very kind about me, about the fund, and fortunately, our team has done a great job, and we have just closed the year, and we thank God and everybody for helping us taking the right decisions, sticking to the right strategy of covered call, and we have returns in excess of 25% at a lower beta of almost 0.7, 30% lower beta, and an average investment of about 75% long position. So, and yes, I have been in the market for more than 3 decades, almost 34 years now. I remember my first investment in 1989. That was a long time back, and I was barely 16. But yes, we have come over the years and tried to learn every day, every year, and in spite of such huge experience in the markets, we can never say that we know enough. The moment we feel we know more, there comes a time when you feel you know nothing. So it is a time to evolve every day, evolve every week, every year. You try to learn more and more. And the order for today seems to be very, very tall, where Kamal said that, we want to know whether, this Volvin covered call strategy or the CC strategy, as we start to call it now, and whether the Volvin Growth Fund Active Rabbit can deliver these returns in all scenarios of the market, whether the market is bearish, whether it is bullish, whether the market is stagnant. So it is a very, very tall order, and he's talked about high growth, equity, high risk. So we have tried to devise a presentation that is a little different and not focusing too much on the fund. So I will request my team member to please share the link for the previous webinar, so that we will not cover in detail what a covered call is, and we will very quickly just go through the covered call, and whoever wishes to know more about that can actually go through the link of the previous webinar. And I admire and congratulate Kamal for doing a great job in putting very incisive questions to the top, leading minds in the industry. And the beauty about him is that he's so passionate himself, and he is not concerned about, uh, I would say, not too much business oriented, but at the same time very focused on learning and trying to bring out from the fund manager what the unique part is and how his people attending the webinar can benefit the most. So his commercial aspect does not proceed over his need to learn more and give his audience some more. So on his request, we've tried to focus more on how we can add value to you as people who want to learn more about this strategy and how you can actually create wealth for your own. So if I can request Kamal, would it be possible for you to switch on our presentation? Kamal, you're not audible. Sorry.
I think you can, share your screen and it'll go live.
Okay. I have to share my screen. Okay.
Vineet, on top, you can see, the fourth button on the top. You can use that to share your screen.
Okay, let me just try to. I thought your people would be sharing, so let me just see how I can. Yeah. All right. So can you check if the screen is visible?
Yes, yes. This is visible. You can just change it to slide
Okay,
mode,
great.
slideshow mode.
Okay, excellent, excellent, excellent. So we'll quickly go over, the agenda, the tough agenda you've given us. How do we move to the next slide? How do we move to the next slide, Kamal? I'm so sorry for creating this.
Stop share screen from your side. I'll play it from my side.
Okay, that'll be nice.
You have to stop screen share.
Okay,
Yeah.
all right.
So this is in front of you. Perfect.
Okay, excellent, excellent. This is good. So, the topic for today is the Volvin covered call strategy. Seems very, very tough. And before we move on, request you to kindly refer to the old seminar we had wherein we have explained what a covered call is in very detail and you can understand. So we will just quickly brush on what a covered call strategy is. And the Volvin strategy has two parts. One is the volatility tracking, and second is covered call or winning, as we like to call it, because this is the strategy that generates returns for the fund in any condition of the market, and especially that condition where the market is at same, let us say if it is at 19500 nifty and it remains at 19500, we will still end up making returns that month, because every month we use this covered call or the winning strategy or the CC strategy to create returns for us. So, like we had explained previously, Volvin philosophy stands for winning through volatility, winning through volatility, and it has two parts to it: volatility part and the winning part. Volatility part covers us tracking the market emotional cycle very, very carefully, and also the stocks volatility, how the stocks are moving up and down. There's an average movement of stocks of about 50 to 60% a year in their own highs and lows, which shows that the volatility of 50-60%, average volatility of 50-60% in a stock price is almost 5 times more we expect from any stock or any equity in general. Most of the fund managers target 12 to 15% returns a year. This is the long-term expectation from equity. But we have to see that each stock, is volatile, or the price difference between its high and low is almost 50 to 60%, which is 5 times the returns generated or the returns expected from equity markets. So it is very, very important for us to track what the stock is doing, because this number itself is 5 times the number that is the expected return. And on the second part, we have the winning part or the covered call strategy. So quickly, like previously, we talked about thrill seekers in the world. These thrill seekers, to gain thrill or to get thrill, will always pay. The riders in the amusement park will pay for their ride. The gamblers in the casino will bet in the roulette or different games, and the probability of their winning is less than 10%. In stock market, people have two ways to make money. You buy a stock and the stock goes up, or you buy a stock and if it goes down, you lose a lot of money. So these days, speculators prefer to buy call options every month. Buying a call option is like a ticket to ride the stock market thrills. The ticket is valid for 1 month. The cost of the ticket is roughly 2.5-3%. So for 1 month, to have the thrill of riding the stock market, you buy a call option that costs around 2.5-3%. It lasts for a month and you get only the profit side. So that is the best part. If the market crashes by 20%, all you do is simply lose the 2.5-3% ticket that you had bought. But what is important to understand is that this premium of 2.5% per se. 2.5 into 12 is 30% a year, and that is where we found a huge opportunity that 30% returns, if these speculators are paying on a minimum side every year, which goes up to almost 60% a year, why not try to encash this return, which is much higher than the average 12-15% return given by an equity market. So that is what led to us creating the first fund in India which focuses on the covered call strategy, or focuses on selling call options every month on the diversified portfolio that we own. So we are not speculating using derivatives or call options. We are a very, very conservative equity fund with lower risk, lower beta, not 100% invested all the time, but still we are trying to generate in excess of Nifty. This year we have generated returns that are close to 9 or 10% over the returns delivered by Nifty 200, which is a benchmark. So just giving you example of the premiums paid by speculators, we have here 5 popular scripts like HDFC Bank, Infosys, Piramal Finance, Tata Motors, Vedanta. So these are varied in their companies, the risk of the companies. And just to give you an example, strike price, we've indicated a strike price, and the premiums that these are trading, this, like, I think this data is a week prior or 10 days prior data. And just to give you an illustration, these are the kind of premiums that people are paying. On the lower side, we see that on HDFC Bank, people are willing to pay, the call option buyers are willing to pay a premium of 1.9% or almost 2% for at the call. And for a stock like Piramal, it is 3%. For Vedanta, it is 3.6%. For Tata Motors, it ranges from 2.9, and the premium varies depending on the call option you choose to sell. So we create a portfolio similar to a diversified equity mutual fund, and then we select what strike price to sell the calls on every month, every day, every hour. Our job is to write as many call options as possible on the underlying portfolio that we have. This is just an illustration showing that the average premiums could be around 1.9%, but roughly the premiums for at the money call options is roughly 2.5 to 5%, depending on the size of the company, any event expected, news or results expected, or if the volatility of the market is high. So this is broadly how we fared in the whole year, and how the NAV, the September figure was not audited. The unaudited figure is an NAV of 125.9. It is yet to be audited, and so we cannot confirm the number. But for the 11 months audited figures, we can clearly see, the figures in orange are the NAV of the fund. The figures in green are what Nifty has done. The long percent shows that on an average, we have been 72% invested. We do not fully deploy all the cash that we have, but we try to see if the market is in greed zone. We do not invest too much. If the market is not in greed zone, we try to go, have a higher weightage of long position. And in the last EQDR is the breakup of the returns we have had from the equity or the derivative segment. So if you see, the total returns in 11 months has been almost 6.97, half of what Nifty 200 has done. Nifty 200 has done about 14%. And on the equity side, this is internal software that we have that splits the profitability on equity or the derivative side. So on equity side, we have almost underperformed by 50%. The magic comes on the derivative side, which we say, is the covered call, where in most the primary strategy that we deploy is covered call, and we sell any call of every month every day, every hour when the market is open to generate maximum possible returns. The average return generate this is 1 or almost 1.5% a month for the 11-month period, giving us almost 17.5% returns, which has helped us create an overall alpha of almost 9% on the portfolio. And all this, like Kamal mentioned, is with a lower beta of 0.7. The beta is not 1 as the market has, but 0.7. And also to mention that our long position has been only average 72%, which shows that the risk from the market has been much lower. And in spite of lower return, we've been able to create a higher return. So it's very, like we talked in the previous seminar, people say it's easy to make returns, but we think it is the toughest part to create more returns, a lower risk. And BlackRock very clearly says making more by losing less. The case for equity covered call closed-end funds. So BlackRock is running a very successful fund in the US. In US, we have multiple funds working because this is the cover page for BlackRock, and it simply says making more by losing less. Reinforcing what we are trying to say, that a covered call strategy may reduce volatility in your portfolio. It believes that by using equity covered call strategy, investors can reduce volatility by capturing premiums without having to sacrifice long-term performance. Now, this is something very big because most of the funds believe that, if you write call in the
Your network is actually,
brochure that,
smooth. Sorry to interrupt. Your network is not smooth.
okay, so just give me 10 seconds.
Sure.
So which part have you missed?
I could understand everything because I was reading slides, but in between it was hanging. That's it.
Okay. So let's just try to. We are trying to fix it, and okay, if you can switch on the slide, let's see if it's better now.
I'm going to switch off the slides, right?
Yeah, so you'll have to switch on the slide, yes. Okay. So coming back to the question that you've given us today, how can you create crazy wealth, in all sorts of situations? We feel, Kamal, like we wanted to add value to your viewers. So we thought it's very important to understand some basic things again. Am I audible now?
It's absolutely fine. Yeah.
Okay. So some very primary things like what is investment, what is risk, what is wealth creation, and something new that we have created, what is magic number. What is long term? People ask कि long term में risk कम होगा, पर long term क्या है? And understanding debt, equity. So I will simply read an investment in an asset or item acquired with the goal of generating income or appreciation. And risk, financial risk refers to the likelihood of losing money on a business or investment decision. So, both things, investment, if we make an investment, does not mean, the work is done. It is very important to understand the risk that our investment carries. And if we can understand it correctly, it will go a long run in creating value for us. And people normally say returns are proportional to the risk taken, right? So, but it's wrong. So we have just tried to define what a very savvy investor has mentioned about risk. Michael Price says the goal is to make good returns with less risk. Risk is not the same as volatility. It is very hard to measure risk. So today we are going to try to attempt to define for our audience, for your audience, how to measure risk or how to reduce the risk. And if we understand what is wealth creation, everybody knows wealth creation is the process of accumulation of assets, investments, and resources over a period of time. It is not a short term thing, it is a long term thing. But what is long term? To understand all these things, we would request you to understand what a magic number is. So, a magic number is a number in percent by which the business or investment growth rate has beaten the inflation growth rate over long term. So, for example, if my business is growing at 10% and the inflation is 7%, that means the magic number for my business is 3. If my business is growing at 7% and inflation is again 7%, the magic number for my business is 0. So this number essentially describes or lets us know what is the kind of wealth we are able to generate or create in the long run. So we're going to take examples, 3 examples in this. These are just examples and illustrations, and the idea is to simply understand what our behavior is and whether our behavior is any one of these, and can we use the knowledge that we gain today to understand what kind of person I am and can I reduce the risk to further enhance the returns on my portfolio and whether I can create some crazy wealth. So first example is, let's say, Mr. C. So Mr. C is a very conservative guy. He is a wealth preserver and he says that I wish to conserve my wealth, and he invests a lot of money in low risk FDs, government bonds, debt instruments generating returns of 7 to 10% pre-tax returns. So these are, if we invest in a lot of these things, most of the debt, we are actually trying to conserve our wealth. Then one is Mr. S, who's very smart. He believes that he's a wealth creator and he's willing to take a slightly more calculated risk, and he invests in government bonds, debt, long short funds, and a bit of equity products. And on the third hand, we may have Mr. X, who could be defined as a wealth destroyer. He may not be a wealth destroyer, but he's very smart and he understands the power of equity, and he invests in all kinds of equity and derivative products without understanding the risk. So that is the reason why we want to call him wealth destroyer, because though his idea is to create a lot of wealth, but if we without understanding the equity and derivative products invest a lot of money in equity, he may have the risk of losing a lot of money and destroying a lot of wealth. He believes in the mantra, of more the risk, more the reward, or more the investment in equity, more the reward. So magic number we already defined is, it's the number, or what is the difference between our portfolio or business return from the inflation rate. So if we see Mr. C, these are the returns of all 3 people: the wealth preserver, the wealth creator, the wealth destroyer. The person who was putting everything in FD, creates a return of 8%, 7 or 8% post-tax. The wealth creator who was putting a lot of money in FDs and some part of equity was generating a return of 10% post-tax. And the person who tried to put everything in equity without understanding the risk could have, bouts of very high returns, but also he will have period where he will lose a lot of money because the returns in equity are not consistent. They vary over the long time. We are going to show, a little ahead how equity could be very, very risky. So the scorecard for Mr. C, the wealth preserver, creator and destroyer, if you see the wealth preserver, this is the most interesting part, that because he was invested in instrument which were generating returns of around 8%, his post-tax return is about 5.6% and his magic number is minus 1.4, showing that the investment in this portfolio is not even beating inflation. So whatever we are investing today, in the long run, we are actually going to compound losing money and we are destroying wealth. We are not creating wealth, we are destroying wealth. And the second part, Mr. S, who was the wealth creator, who had a mix of debt and some equity, he has possibly given returns of 7.5%, 8%, and he has a magic number of something around one half or one, and he is actually creating some wealth. But the third case, where Mr. Wealth Destroyer, he put everything in equity without understanding the risk. He has sometimes generated huge returns, sometimes generated negative returns. In the end, he is also destroying wealth in the long run. So what is important? What is the right way to create wealth? Is it impossible? We believe it is not impossible, but if you carefully understand just these three simple things, these are the three magic mantras to create crazy wealth. One is the magic number, we've already explained, is to understand that the post-tax returns of all our investments on an average should be more than the inflation, because that is the only way you can create wealth. Second is to understand what is long term. Everybody says long term के लिए पैसा लगाओगे तो बहुत पैसा बनेगा, कोई risk नहीं है. But what is long term, and what the third thing is what actually is the power of compounding. So we've tried to explain these things to a layman, that or even the smart people, how understanding long term and understanding the power of compounding can actually create crazy wealth. So this sheet, if it is visible to you, if you carefully see this sheet, Kamal, I hope it is visible. It shows how Nifty would have done in the last 22, 23 years. So if somebody is investing for a horizon of only 1 year, you will see mostly the returns are green, but there are bits of reds in this. Some years you are losing money. If somebody invests for a period of 2 years in equity, you will see again there are bits of some reds, but mostly greens. If you go to 3 years, the number of reds is reducing. If you go to 4 years, it is further reduced. If you go to 5 years, it is very, very few reds. And 6 year onwards, there are hardly any reds. So if somebody asks you to look at this data and asks you what is long term and what is the horizon you should invest at, the answer is very clear. So if I will break it up for you, it says very clearly. So this is the equity performance over 1 year. There are some reds. For 2 years, it is decreasing. For 3 years, again further lower reds. 4 years lower, 5 years lower, and 6 to 10 years is almost negligible. So the answer is long term means if you invest with a horizon of 5 or more years, there is a near 0% probability that you're going to lose money. So this is what we would want people to understand, that risk means not putting in money anytime, and be very careful about putting it for long term. But if you see the data of 1 and 2 years very carefully, 1 year the probability of losing money is 25%, but for 2 years the probability of losing money is not less but 32%. So this shows the returns from equity are not linear. Of course, we know 12% is the average return. Kabhi aayega, kabhi jayega. Long run mein 12 banega. But a data of 2 years clearly shows that when you lose money in equity, you will lose much more, because the returns are not linear. When the market goes up, they will go up too high. When they go down, they will go too down. So one has to be very, very careful as to understand what would be a right period to invest the money. And if equities have been giving a great returns for last 2, 3, 4 years, I would be very, very cautious, especially if they are giving a return of more than 12%. So we see in the last 6 months or even 3 years, Nifty has given return of more than 60-70%, which is like a crazy number. So it is time for us to be very, very cautious. We are not saying, do not put the money now. But if we are a conservative person and if we look at the past data, we will not want to be too much heavily leveraged on equity right now, because 3 years have been very good, 4 years have been decent. So why not have a reduced exposure, or consider that the risk, if I am putting some money, this may not be the right time to put money for short 1 or 2 years. Only if I am sure that I want to have this money for more than 5 years, would it be a decent decision. So, and this is, by understanding the power of compounding, if you see the difference that, various people, we had wealth creator, wealth destroyer, wealth preserver. Even if a person has been able to create a very decent return of post-tax 8%, which has a magic number of just one, it will show that in 25 years the amount has been compounded at, we reach a figure of a 1 crore investment reaches a figure of 6.84 crores. Whereas if you can find a product that is, let us say, 11.7, an average return of post tax 11.7, or something crazy, if we can get a product of 15% post tax returns, the final amount comes to a staggering 32 crores. Now, how can we summarize this? An investment of 8% and an investment of 15%, the difference is 5 times. It is like putting, 5 crores in a mix of debt and equity now, and putting just 1 crore in an investment which is giving 15%. 5 crores, the return that you generate from that in 25 years in a conservative investment. But whereas if you have calculated right and analyze the risk correctly, and you can identify an investment to give you a return of 15% post tax after 25 years, the amount is staggering almost 500%, or 4.8, 4.9 times more. So this is, assuming that we are able to understand the risks of the market, and we do not put, too much money in equity at the wrong time. And when the markets are down, when they are giving excessive negative returns, that is possibly the right time to get returns which are higher than 15%. So what we say is, there is no such thing as bad weather, only different kinds of weather, as has been defined by John Ruskin. So how does this, do for our fund, the question that you had put for us? So, we have 4 scenarios. We have scenarios of bearish 12%, stable 0%, bullish 12 when the market is bullish 12%, and extremely bullish market of 24%. So quickly, we are just going to, in the next 2 minutes, run you over these returns, that if Nifty has given a return of negative 12%, there are chances that on the equity side, we will do 50% of what it has done, and we will be negative 6%. But on the derivative side, we, by selling call option premiums every month to a tune of, 1.25, 1.3, 1.4, 1.5, 1.6, 1.7% a month, we generate returns of 15%, which will mean a gross return of just 9% maybe, but an outperformance pre-tax of 21%. So, even in a bearish scenario, when, most of the strategies will lose money, simply because we are writing call options every month at every price, trying hard to, give these returns, which we feel the call option premiums are an average 3%. But, we have been able to successfully sell call options at maybe between 1 and, 1.78% per month, averaging 1.5% over the last few years only. So if we take that number and even put it down to 1.25%, we still are outperforming the market by a staggering 21%. Scenario B is if market is neutral, it does nothing. So on the equity side, again, we do nothing. But on derivative side, if we are selling call options, we end up generating returns of almost 16, 17% the whole year. Because, this is possibly the best case scenario for the fund. When the market does not do anything, nobody makes any money. But because we are writing call options every month, every hour, the market is open, we are generating returns of 16, 17%, which is, a huge outperformance to the Nifty. Now, what does the Nifty do, when it is bullish? Again, like we have done this year would be a classic example, when Nifty did 14% and our fund did almost 26%. So this number also of 24% is very, very close to that number. So there's a slight calculation error. It is not 1.25%. We assumed it as 1.5% because when the market goes up, there is more interest by people, and generally we have seen the call option premiums rise. So in a bullish scenario, we have outperformed the market only 12%, but we have been able to give an overall gross return of 24%. And what if it's extremely bullish? So this is not very, very good scenario for us, because overall we have also delivered very good returns, but the outperformance keeps on reducing, as the market is more and more bullish. And the only drawback we have in this scenario is if the market is too bullish, it may be better to buy equity directly, and not invest in the fund, because equity might do slightly, better than us. So, but I would say this is still a good scenario, because many investors would still be happy getting returns of 24, 25%, the way we have done this year, where the market may have delivered maybe slightly more than us. So in all scenarios, we have tried to either do very good or not so good. Only in the extremely bullish scenario, when the market has been too bullish, we have not outperformed the market in a great deal. But most of the scenarios, if the market is down or if it is neutral, we have tried to outperform the market or delivered fairly good returns in, high teens number. So just, sharing this picture again, which shows that, we've delivered returns of 1.59% on an average every month by writing covered call options, resulting in an NAV or a return, annualized return of almost 26%. These are pre-tax numbers. And what is something very important that we have done is our team has been very careful not to churn too much. And we are trying to, for example, in another 2 months, we believe that our post-tax NAV is close to be 18 or 19%, returns plus, because we have been very careful not to sell most of the portfolio, and our churn rate is less than 20%. So we are also trying to generate returns by not selling the portfolio too often and maintaining a long position for more than a year, so that our fund, gets a hybrid taxation. So we are expecting a much lower taxation than 39%, which will make sure that the post-tax returns for our investors is very, very good. And as we explained earlier, it is very important to see the post-tax returns, because that is what defines whether we are creating wealth or destroying wealth. So Kamal, we are the house is open to any questions by you.
Perfect, Vineetji. Let me just stop the slideshow. So, I have been kind of, I would say, moderating webinars with a lot of long short fund managers, and the long short funds as a segment has been kind of, I would say, evolving, emerging, and now establishing itself. There are a lot of well-known players like Avendus, Edelweiss, Tata, many well-known names. But your strategy, as you mentioned in the first place, is a first of its kind. And you, I know, throughout your presentation have not talked about long short style, but you have maintained that this is a covered call strategy. And I want you to first explain what do you mean by first of its kind.
So, long short, the meaning of long short is that most of the portfolio fund managers, they will maintain some long position and some short position. And I have to admire the people in the long short funds, especially Tata Long Short, Harsh, and Helios, the kind of work they are doing is simply amazing. We make a lot of mistakes, but our strategy covers up for our mistake. For example, if I buy a stock, the stock goes down, I should lose money. But because I've sold a call option, we end up making money. Then again, if we are writing a lot of calls, the stock market goes up, we should be losing money. But because we have the equity long, we end up again making money. So the strategy itself is reducing the risk for us. But for a pure long short fund, both their calls, if they are shorting one stock and if they are buying one stock, only if both the legs are right will they make money. So what they are doing, I feel they are doing the most fabulous jobs, because what do most of the long only funds do? They will simply invest for you in the market and they will sit tight. They will keep on investing money, the market will keep on going up, but when the markets are falling, they are helpless, they cannot do a thing. So, at the most, when the markets are going up, they will do slightly better than the market. But these funds, which are very heavy on small cap or mid cap, if the market start going down, they will lose much more than the market. We have seen this in past 20, 30, 40 years. There's very clear data that small caps are best bought when the markets are down. And when the market is at peak, you should be shifting your funds to more large cap, more stable companies, and not have too much money in the small cap funds. So you're coming back to your question of long short fund. So these long short funds, the aim of the industry is to deliver some returns, pre-tax returns of somewhere between 10 to 15%. So why would I park my money in a long short fund? Is only because if I am not sure or I do not have a clarity of what is long term. If I have money available for me for short duration, let us say 3 months, 6 months, 9 months, 1 year, then a long short is a good, because you cannot, as we saw what is long term, if it is lower than 5 years, it is better to take less risk and have a return of post tax 8 or 9%. But if you carefully analyze, that is only 1% more than the inflation number. So are we creating wealth? No, we are not. We are simply conserving our capital if we invest in long short funds. But what we are offering, we technically sell call options, we sell futures when the profit is booked. So we figure in the long short category. But are we doing the same? No, we are not. We are writing call options every day, every hour when the market is open, trying to create that extra 1.5% return every month in any kind of market scenario. And we focus that even if the market is at zero, we should be able to generate 18 to 20% pre-tax. No, there are no guaranteed returns in equity, but we are trying every day to be more conservative and sell call options, so that even if the market goes down, the call options we have sold will return in what of money for us, and that is what the fund is doing. So are we the same as long short? No, we are not. And are we very careful about taxation? Yes, we are even more careful about taxation, because we do not churn. If I have to sell a stock, I will not sell it in cash, but I will sell it in future, so that after 1 year, the fund has a bigger post-tax return. And that is what we are aiming. If we are able to, I think in the next 2 months, our post-tax annualized return will be in figure exceeding 18%. So now this is an exceptional market condition. But anywhere, anything above 15 to 18% is a huge wealth creation number. So we saw that, if you are generating 8 or 9 in long short, or 10, you have a magic number of 2%. That is the power of compounding. But if you can have a number that is higher, you are going to create huge wealth. So if you know the horizon of your investment can be a little more, a little longer, then you should not be parking your money in debt, but you should be parking some portion of that money, or greater portion of that money, depending on your risk appetite, on a wealth creating side, and not on wealth preserving or wealth conserving side.
Sure, Vineet, understood. So, subsequent question that comes to mind is that when you mentioned that your portfolio's churn rate is 20%, there is this gentleman who has asked this question. If one is selling at the money call, then if the price of the stock is above the strike price, then one has to sell the holdings that one is kind of, maintaining is one's portfolio.
Correct.
How is it
That is
then
right.
turnover only 20%? How you're maintaining only 20%
So
turnover?
that's what I just said, that we will not sell the stock in cash. We will sell the stock in futures, and it becomes an arbitrage position, wherein we earn about 8.5% in arbitrage till we get opportunity. For example, we had bought Delta Corp almost 7-8 months prior. So we bought at 180, 200, and the price went to 230, 240, and we booked all the profits by selling it in future. Earlier we were selling call options, but there was a time when we wanted to get rid of the position and we sold the futures. Or we didn't know that GST, is going to be increased, and the stock suddenly came back to 170, 180 levels. So we simply, bought back the futures and made a fresh, it was a fresh long position again. So we did not have to sell the stock in cash. So if we need to book profits, we will always, use futures side to book the profits and exit the stock rather than churning it on the cash side.
Understood. What is that one scenario, which you can call as a unexpected risk to your kind of approach? Because I'm sure, as you said that, you are constant learn, in the constant learning uh, believer. So obviously, over last 1 year, I'm sure there would be something that you would have learned, and that would have kind of made you kind of believe that if this happens, then my fund can actually give underperformance. So that is one factor which kind of keeps you fearful in all weather style of fund management, is what I want to understand.
So, Kamal, your question is right. And, equity is such a thing that if a market tomorrow cracks 20%, we are very, very willing to take that kind of risk. So, the only thing we have done to reduce our risk is one, on an average, we are, let us say, 75% long. So, if the market falls by 10%, we are going to fall only 7.5%. And because we are selling 1.5 2% calls every month, we are not going to fall by even 7.5%, but we are going to fall by 6%. So further the risk will be lower than equity. But are we a product that is the safest product? No, we have a similar risk to equity, only that we are 30% lower risk than equity, and every month, in spite of whatever market conditions, we will generate some returns by selling call options. So the risk is similar to equity, only we are 30% lower. So we are a conservative equity fund which believes in generating returns month on month on month. So we have whatever the risk that equity has, only 30% lower. So if market does fall, we also fall. We fall slightly less, and we will rebound quickly because we sold calls this month, and as soon as the month ends, we will again sell calls. So we will be, the fall will be muted. We will not be as hurt as equity market, but we will also get hurt, definitely.
See a scenario, where market is actually rising on one side, like we saw in 2020, 21, where market went up from bottom after COVID. How will your fund perform in that kind of scenario?
So this is the worst case scenario for the fund, because like I said, if markets deliver 30-40%, we may be left with only 25-30%. We may actually underperform the market, if you will. So if a fund manager or if an investor is there who says that, okay, Vineet, I want to see how you have outperformed. So, our heads will be down and say, we are very sorry, sir. We have underperformed the Nifty by 10%. If you put money in Nifty or in mid cap or small cap or any kind of fund, you would have made 10% more. But on the other side, if we have an investor who says, oh, I was looking at 15% return, I do not know what will happen in the future. So we've done a great job. We've given you 25-30% returns. That is a great job. So, you have both kinds of investors. If somebody will compare us only on outperformance criteria, we will be very sorry, and we will paint a sorry picture for ourselves, and we will say sorry, we have been underperformance, and Mr. Market has done better than Volvin Fund. But if somebody does not know what the future is going to be like, we'll say, okay, we have done a great job, and the returns have been very, above 25%.
Right, Vineet. So basically, your fund is meant, for that portfolio allocation, which is basically not going into equity out of fear of losing principal and kind of seeing negative returns. So your fund actually enhances confidence to attract that pot of money, which, as I rightly mentioned in the beginning, which is lying into debt or maybe arbitrage fund. Now,
So I would want to say, Kamal, that if you know for sure the market will go up next year, please put money in equity. If we do not know that we can time the market, we are there. We will make, either very good money, good money, 15, 20, 25% kind of money, or in the year that, everything does well, we will make only 25%, 30% and not 40%. So I would say most of the scenarios, the strategy will do very well only in the scenario when everybody is made too much money, like this year. But this year too, we have been able to beat Nifty 200 by 10%. But if the market keeps on going up and it goes to 21, 22,000, we might say we are really sorry, the Nifty is, beating us, and we are not doing that. So in an uncertain environment where we are not sure, what the market may do in the next 1 or 2 years, it is a very good strategy to put money in a conservative equity fund like us, which will try to generate try to generate returns month on month by selling call options.
On a lighter note, your fund is actually, I would say, a solution to one of the biggest risks. One of the biggest risks, as said by Mark Zuckerberg, has been not taking the risk. So those people who are not taking the risk, you are trying to give them comfort to take the risk.
That is right.
So I hence in that regards, obviously, the fund looks to be interesting. But the real question is that we are sitting in India and we rhetorically have a lot of hope. And we are saying from 3.5 trillion economy in 5 to 7 years, we'll be a 7 trillion economy. Mostly the asset which goes to equity, because your portfolio ultimately has equity as an underlying. As you said, if market falls, you will also underperform, you will also fall. So obviously, if one has to invest with a longer term horizon, why not actually kind of, invest into equity and make higher returns, then invest in kind of fund like yours? Because I'll tell you how investors' mind will think. Investor who is not investing into equity, your fund will kind of prepare him to invest in equity. Say he gives money to you, he will kind of make some returns from your fund, and then he becomes now a investor who has mastered the art of equity, who has kind of familiarized with equity, and now he will become greedy and he will feel that if I had put money in equity, I would make more. So his future allocation will go to long only. So to such kind of confusion, to such kind of thought process, how will you tackle eventually? Because then it could happen that people may come to you and then people may then start to kind of think of going to long only. So you are kind of opening the door to introducing people to kind of equities as an asset class by giving them comfort of maintaining lower beta, lower volatility, winning through volatility, as you're rightly mentioning. But eventually, one will want to build wealth, as you mentioned, crazy wealth. So what is the answer to this thought process?
So I think one has to be very careful about two things, Kamal. One, we showed that returns from Nifty are not stable. They are not linear. By linear, I mean 12% return आएगा, 12 ही आएगा. अगर inflation 7 है and companies borrow at 10 and they invest further at 13, 14, 12, 13, 14, 15, returns cannot exceed 12 to 15% over a long period. It cannot. That is the law of average. And if I am sitting in a euphoria like this, I better not forget that. So if somebody can time the market of buying only when the market is crashing, buying heavily when the market is crashing, and taking out the money when the market is at peak, like now, it's almost euphoric. People are saying, abhi to bahut paisa banega. And if you're sure about it, please put the money in equity. But if you have any doubt that we might lose money, then we are a conservative strategy where we are not fully invested. We are like, right now we are only 50% invested. We are not convinced the valuations are going up ahead too high. But if in the pre-election year we get a big correction, if we feel the value is there, we will be willing to go to long of 100% plus also. You see in one of the slides earlier, we were long at 102 because in April we felt the market was great value. So we are not sitting here, trying to do a very normal job of writing calls. Our team is expert in checking the valuations, the fundamental study, the macroeconomic situation, and also measuring each and every technical parameter of the index of the stock to put in the right money at the right time. But right now, we are not comfortable. We feel the market has run up too fast, too soon. We are going to be conservative. But if the market corrects, the valuations are right, we can be very aggressive as well. So, it is very easy to say for anybody, a common man, that if he can identify what the future is, please go long in equity, and we would love that, equity creates return. But if we are, but that time should be when the market is correcting and crashing, not when the market is at peak. And if you are unsure what the market will do, this strategy will generate some returns every month because there are speculators. India is a 3 times bigger market than USA in speculation, in derivatives, in call options, in options. And India is only 10% of the market in cash segment of the US. But in option segment, it is 3 times bigger than market. To understand, it is 30 times bigger than market than the US for options. So you can see how much speculation is going on in India. And till the speculation is on rise, we are very happy selling call options to those speculators and trying to earn a return of, let's say, 15-20%. So we feel it's a great return. If these speculators are willing to pay, why not? Let them pay for their thrill. And we are willing to be conservative and get earn from that thrill need they have.
Yeah, absolutely. I think this is a very practical product which balances risk, balances, I would say, greed and fear, both elements. Fear actually, keeps people away from equity. Greed kind of makes them take wrong decisions, and your product actually is a solution to both these emotions. Absolutely. So, let's talk about some of the more product related aspects for the last 5 minutes. If anybody wants to invest in your AIF, what are the kind of, I would say, charges, exit loads, minimum, I would say, commitment, minimum investment horizon you suggest? What are the answers to some of these?
So the minimum investment is 1 crore as prescribed by SEBI. That goes for all category 3 AIFs. And the minimum horizon that we would request a person is 1 to 3 years. And right now, I would say 1 to 3 years because we feel the market is slightly heated. And, we will not ask somebody to put, open money in equity, putting money in equity that will at least, yield some return by selling call options is, I would say, a preferred thing. But if the market corrects a lot and we see value, we may tell people that, okay, you can put even with a horizon of 1 year. But for an open equity product, I will always say that, today people have understood what is long term. So if you are investing in a strategy for, in a conservative strategy like us for a longer period, it gives us a great option to create a huge number for you in 20-25 years. So, and I would request the audience, if you put a lot of money in 8, 9 or 10% kind of products, it is good to preserve wealth. But if you want to see your next generation, reaping the benefits of compounding, you must put more money in equity when the markets are correcting, or put more money in a strategy like covered call, even though you can have your own family office create that, because it will keep on generating returns for you even if the market is not moving up. The last year was a classic example. Kamal, Nifty was at 17,300 something this 31st March, and last year it was 17,400 something. 0.5% down over the year, 0.5% down in 1 year. Mutual funds did nothing, but our proprietary fund, delivered returns in excess of 24%. So that is a classic case for us. The market is stable, market does not do anything, and you generate returns of 15-20%. So that is a classic case. We feel we cannot predict what the market is going to do. So it is better to put in a strategy that is going to deliver you good returns, good outperformance. Only if the market goes up 40%, we will say, we are sorry, we delivered only 25-30%. So, that is the only downside which we feel is not a big downside.
Sure, Vineet, what is the NAV frequency and what is the exit load?
So the NAV frequency is every month end. We have to come out with the NAV audited figures, come out by around 7th. So 7th of the month. And the exit load is below 6 months. There's an exit load of 2%. The reason for that is that like most of our funds this month and next month are going to be long term in nature. So the tax is paid by the fund, not the investor. So as most of our funds are long term now, so even if an investor comes for 3 months or 4 months or 5 months, he has not stayed in the fund for a year, but he will get benefit, of long term taxation that the fund is undergoing right now. So we are in like a hybrid tax. We do not have all taxation at 39%. We have most of our taxation at 12%. So, if the investor comes for only 5 or 6 months, even though he has invested for only short term, he is going to get benefit of, the long-term funds of all the long-term investors. So there is a 2% exit load, which is almost equivalent to, what he would have paid, or if he had stayed for 1 year more, then, his taxation would have also been lower. So it is only to compensate those investors who are staying in the fund for long term, so that their returns are not taken by somebody who's staying for short term. So below 6 months there's an exit load of 2%, but after that there's no exit load.
Can you please explain, Vineet, what do you mean by most of the tax is 12%? How is that 12%?
So see, for investments, if we have there are 3 kinds of taxation that we have. We have a long term tax for of 10% plus surcharge for the investments we have for more than 1 year. We have a short-term tax of 15% plus surcharge for investments we sell at less than 12 months period. They get classified as 15%. And we have a derivative income every month we get by writing covered calls, that is taxed at 39%. So the overall taxation of the fund is a mix of all 3. So if we have a 20% churn rate, 20% of our equity portfolio would be taxed at 15 plus surcharge. 80% of our funds in the equity portfolio would be taxed at 10% plus surcharge. So the taxation is even lower. But for all the derivative incomes that we are generating by writing call options, they are going to be taxed at 39%. So the overall position of taxation of the fund will be somewhere between 12, 10, 15 and 39%, let us say around 20 or 22%. So that is the reason why we are saying on a post-tax basis, even though our NAV may be 26, right now 25-26%, but post-tax it is going to be more than 18 or 19%, which is a huge number, which is a great magic number. So if we can hope to repeat this performance year on year, we can create huge wealth for all the investors, potential investors that we have.
Understood. The blended tax is like 20 to 22%, right? Understood.
Yes. Yes. So it will keep on varying upon, depending on the actual market scenario.
Sure. What is the fund management fees? What is the overall cost structure of the fund?
So the management fee for the fund is 2.25%. And there is a performance fee above 12%. So up to 12%, this is without catch up and with high watermark, which means that up to 12%, the fund will not have any more performance fee. So there's from 12 to 24%, there's a performance fee of 12%, and above 24%, the fund also has a performance fee of 24%. So many of these long short funds currently have 20% without catch up. So but R is with catch up, so above 12% only. it is only above 12% returns that we will be charging 12% as performance fee, and anything above 24% we'll be charging at 24%.
Understood. So basically, there is some fixed fees. It's a hybrid fee, and then there is a performance fees with catch up with a hurdle rate of 12%.
Right, that is correct. That is correct.
Sure. So, if I may ask this last question, what is your personal skin in the game in this fund?
So we have, put in our family and friends whom we put in the sponsor category, and they have put almost 20 crores in the fund. So we did not want that if there is any market correction or anything, the fund manager will go scouting for money. So just to secure that, that much money has been put, and all the money above that is coming from the investors.
The kind of interactions you would be doing with family offices and large clients over last 1 year, what's your kind of vision in terms of the size of the fund, say in next 3 years?
So we would expect the fund to be between 200 and 500 crores in the next 2 to 3 years, and it could be more also. So this is a conservative estimate that we have, and we have seen how it takes 1, 2, or 3 years is a magic time when suddenly the good performers, they start to get rewarded. So we are also planning to launch another fund by the name of Rabbit Returns, wherein our mantra is going to be, and we are going to target an audience which wants some returns every year, to spend or for their education or for whatever goals they may have. For example, a lot of people want to gift these to their elderly parents, or parents want to gift it to their children, wherein they want both capital appreciation and some returns. So we are going to try in that fund that about 7%, which is the FD rate, we are going to be giving out every year, every quarter, 1.5%, 2%, for 4 quarters, about 7 to 8%, wherein the people, the investors get an income, and also try to generate an alpha of 11 to 12% that equity does in the long run. So it is simply because the strategy itself creates a higher return. So we would want the elderly and the couples caring about the children's need to invest in that kind of product which offers a capital appreciation as well as annual returns.
Thank you so much. I think this was a very insightful webinar. Many good wishes to you. Before we wind up, I would just like to ask one last question, and then this question is basically on your opinion on the market, because we have been asking opinion on the market in almost every webinar, but we have been doing webinars with long only fund managers who have no other option but to say they are bullish at all times. But as you said, you have created an all-weather fund. But honestly, hand on your heart, we have seen, like you mentioned, 1 year ago, markets had not moved anywhere. Like in August, September, October, I remember 2021, markets were at like 18,600 levels. Today, markets are at 19,600 levels. So in 2 years, in absolute terms, Nifty is up only 4 to 5%. If I compare, levels, and at the same time, earnings have actually grown. But despite that, you have mentioned that markets are at kind of, not attractively valued, and your fund is 50% kind of taking conservative approach. So what is your, approach at the moment? Is it because your fund is conservative, hence you are turning conservative, or there is a real, reason for one to actually be scared from the market at the moment for next, say, 6 months? And that is
so, yeah, thank you. So we can, comment about market only. So why we feel there is almost euphoria in the market is not in the Nifty per se. Nifty at a 22 PE forward is a very decent rate to invest in. But few reasons why we feel are very risky is, one, the market is run up too sharp too soon, especially in the small and mid cap, where nothing is changing for these companies if they are not in defense or infrastructure. So defense and infrastructure, if you do not consider these sectors, why a commodity company, a steel company, all these sectors which are into commodities, why are the prices still running? The valuations are in 20 PEs, these historically are in 6, 8, 10 PEs. So we feel, a lot of exaggeration is going on in most of the sectors. Even engineering sector, you have P's of 60, 70. FMCG sectors, you have P's of 80, 90, 100. And look at what they have done in the last few years, 1 year. Their top lines are not growing, their margins are not expanding. So the reason for a stock to go up, there are four reasons. One is, you have top line to go up. Second is your bottom line will go up. Third is your margin expansion will happen. And fourth is the sentiment. The sentiment, the PE multiple goes up. Today, most of these stocks in the mid cap and small cap segment have not gone up because of top line margin expansion, but the stock prices are going up only because of PE re-rating, only because of sentiment. So we are seeing that even in IT companies, they are saying the future is not great. So why should an IT stock still go up when the management itself is saying be conservative, but the prices are going up? So you have a strong retail. The money is coming in retail in a very big way, and the young generation, they are understanding the power of compounding. They are putting in a lot of money in SIPs. The SIP flows are very, very high right now, so more so than the foreign investors. So that is the reason the markets are not correcting. So Nifty is not a very, very overpriced. Nifty is decently priced. But when these all penny stocks and mid caps and small caps, if they start to correct, we see the fund flow starts from the market, and the Nifty can also correct. So the more of a caution has been created by the mid cap and small caps that have run up too fast. Even the FMCG sector, we feel QSR, FMCG sector at 80, 100 P's, you're not going to see 20% growth for each of these QSR companies. For example, Jubilant Food, you have McDonald's, you have these a lot of companies in the food sector, and these companies, Tata Consumer, Starbucks, they are expanding 20, almost 20 to 30% annualized. Most of these companies are expanding their outlets. But is the sector going to grow more than 15%? So if the sector is growing only at 15%, but expansion is going at 30%, there are chances that the margins are going to come down. There is going to be a lot of competition. So we are expecting, a lot of competition to go ahead. Inflation is up. Interest rates are not going down globally. It is a pre-election year. The governments have a tendency to look at, freebies more than the interest rates. So if the interest rates keep going up because the government is spending a lot for the country, trying to just rev the economy or move up the economy, there are chances that the margins of many companies, which are going to face huge competition because of over expansion, the profitability sooner or later has to come down. You cannot have the expansion at 30% and margins going up also. So it's either you expand and compromise on your margins. So we have seen the expansion in textile, steel, QSR has been more than the market growth, which is going to hamper the margins in the long run. And being a pre-election year, it is better to be safe than sorry. For 12%, 15% return, shouldn't I park my money at something conservative right now? Rather than for 4-5% extra returns, why should I risk a 20% downside? So we just want to be more conservative because of various reasons, like pre-election year, higher interest rates, higher crude prices, lower industry growth, lower expected margins in the future. Global recession is there. None of the continents are doing good. All these factors are not great. Only the construction, infrastructure, and defense sector in India is doing crazily well. What about the other sectors? So, and in Nifty, we do not have these sectors at all.
Right.
So, just point to be cautious here.
Sure. So this is well put. Absolutely. So every fund has a space in the portfolio. If one wants to make well-informed investment decision, obviously, one can actually look towards such alternate products, because such alternate products actually provide better experience, as I mentioned, to manage one's emotions of, greed as well as fear. And hence, this webinar has been quite insightful. Interaction with you has been quite insightful in terms of understanding the overall context, logic, belief, as well as approach of your fund. Thank you so much for your time, and wishing you all the best for your future. Thank you everyone for joining with us today.
Yes, thank you so much. There are some queries, they can reach out directly to us, or through you, Kamal,
Sure.
which we have not been able to answer. The email ID is info@volvin.com, or, you can connect to Kamal, and I'm sure they would be willing to, forward your queries to us, and we will be most happy to answer any queries relating to leverage or negative months, so if you want to understand. Thank you so much, Kamal, and your team.
Right. My pleasure.